Picture this. A metal that's been trapped in a cage for 4 decades suddenly breaks free. Not just any breakout, we're talking about silver smashing through a resistance level that's held since the early 1980s. And if you understand what this means, you're watching one of the most significant wealth transfer opportunities of our lifetime unfold in real time. Let me paint you a picture of what just happened. Silver didn't just nudge past some arbitrary price point. It obliterated a technical barrier that's been in place since Paul Volcker was fighting double-digit inflation, since the Hunt brothers tried to corner the market, since most people reading this weren't even born. We're talking about a resistance level that's older than the internet, older than cell phones, older than most of the financial instruments we trade today. And here's what makes this absolutely explosive. When a market breaks a multi-decade resistance level, it's not just a technical event. It's a fundamental shift in how the world values that asset. It's like watching a dam that's been holding back water for 40 years suddenly crack wide open. The question isn't if the flood is coming, it's how massive it's going to be. Now, let me take you back to understand why this matters so much. In 1980, silver hit its all-time high of $50 an ounce. That wasn't just a price spike. It was a moment when the world lost faith in paper currency. Inflation was running rampant. The dollar was in crisis. And people were scrambling into real assets, into things they could hold in their hands. Silver went parabolic, and then it crashed, hard. What followed was 4 decades of what technical analysts call a cup and handle pattern. Imagine drawing a teacup on a chart. That's literally what silver's price action has looked like for 45 years. A massive run-up, a long, slow decline, a gradual recovery, and now, the handle is breaking. And when a cup and handle pattern this large completes, the price targets become almost unbelievable. But here's what most people miss. This isn't just about lines on a chart. This is about fundamental forces that have been building pressure for years, and they're all converging right now. Let's start with what's happening in the physical market, because this is where the story gets really interesting. Silver isn't like gold. Gold sits in vaults. Central banks hoard it. It doesn't get consumed. But silver? Silver gets used up. Every solar panel that gets installed consumes silver. Every electric vehicle that rolls off the assembly line contains silver. Every 5G tower, every smartphone, every medical device, they all need silver. And here's the kicker. They need more of it than ever before. The solar industry alone is projected to consume over 200 million ounces of silver annually within the next few years. Think about that. The entire global silver mining production is around 800 million ounces per year. One industry is going to eat up a quarter of all the silver that comes out of the ground, and that's just solar. Electric vehicles are using 3 times more silver than traditional cars. The green energy transition isn't just a buzzword. It's a massive industrial shift that's creating unprecedented demand for this metal. But here's where it gets even more interesting. While demand is exploding, supply is barely growing. Silver mining is incredibly difficult to scale up. Most silver comes as a byproduct of other mining operations: copper, lead, zinc. You can't just decide to mine more silver. The ore grades are declining. The easy deposits have been found. And it takes years, sometimes decades, to bring a new mine online. So you've got demand going vertical and supply that's essentially flat. Any first-year economics student can tell you what happens next. But there's another layer to this story that makes it even more explosive. Let's talk about what's happening in the paper markets, because this is where things get really wild. The COMEX, the major exchange where silver futures trade, has been the center of controversy for years. Critics have long argued that the paper silver market, the futures contracts, the derivatives, has been used to suppress the physical price. Whether you believe that or not, here's what's undeniable. The ratio of paper silver to physical silver is astronomical. There are estimates suggesting that for every ounce of physical silver that actually exists in COMEX vaults, there are hundreds of ounces of paper claims on that silver. It's like a bank that's issued 100 times more deposit receipts than it has actual cash in the vault. As long as everyone doesn't show up at once demanding their money, the system works. But what happens when people start asking for delivery? That's exactly what's been happening. We're seeing record demand for physical delivery. The premiums on physical silver coins and bars have been elevated for months. Dealers are struggling to keep inventory. And when the paper market starts to disconnect from the physical market, that's when you get explosive price moves. Now, let me tell you about what the smart money is doing, because this is where the story gets really compelling. Central banks have been accumulating gold at record pace. Everyone knows that. But what's flying under the radar is what's happening with silver. Institutional investors are starting to wake up to this opportunity. Silver ETFs have seen massive inflows. The largest silver ETF in the world has been adding metal to its vaults at a pace we haven't seen in years. And it's not just financial institutions. Industrial users are starting to panic buy. When you're a manufacturer and you realize that the metal you need for your production line might not be available at any price, you start hoarding. You start building strategic reserves. And that creates a feedback loop that drives prices even higher. Here's something most people don't realize. Silver has always been money. For most of human history, silver was actually more important as currency than gold. The word money in dozens of languages literally derives from the word for silver. The dollar itself was originally defined as a specific weight of silver. But over the past century, silver got demonetized. It became an industrial metal. People forgot about its monetary properties. But here's the thing about monetary metals. They never really lose that characteristic. It's embedded in human psychology, in thousands of years of history. And when people lose faith in paper currency, when they see inflation eroding their purchasing power, they remember. They go back to what's worked for millennia. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical precious metals into your retirement account without tax penalties, and why some people are looking at silver as part of that strategy. Worth checking out if that's relevant to your situation. Now back to what's happening right now, because the timing of this breakout is absolutely critical. We're living through a moment of unprecedented monetary expansion. The amount of currency that's been created in the past few years is staggering. Every major central bank has been running the printing presses at full speed. And while they talk about fighting inflation, about raising interest rates, the fundamental trajectory hasn't changed. The debt levels are too high. The political will to make hard choices doesn't exist. The path of least resistance is more currency creation. And here's what that means for silver. As a tangible asset with real industrial demand, silver becomes a hedge against currency debasement. But it's more than that. Silver is also a speculation on the green energy transition, on the electrification of everything, on the technological transformation of our economy. It's both a defensive play and an offensive play. That's a rare combination. Let me tell you about what happened in 2011 because there are some eerie parallels to today. Silver went from around $17 an ounce to nearly $50 in less than a year. It was an explosive move driven by a combination of monetary fear and physical demand. But here's what's different this time. The fundamental demand picture is so much stronger. In 2011, solar was a niche industry. Electric vehicles were a curiosity. 5G didn't exist. The industrial demand for silver today is multiples of what it was back then. And the supply situation is worse. Mining production has been essentially flat for years. The above-ground stockpiles that existed in 2011 have been largely depleted. The silver that governments used to hold in strategic reserves, most of it's been sold off. We're in a structurally tighter market than we've ever been in modern history. Now let's talk about what this 40-year breakout actually means from a technical perspective, because this is important. When you have a resistance level that's held for decades, it becomes incredibly significant. Every trader, every analyst, every institution is watching that level, and when it breaks, it triggers a cascade of buying. Stop losses get hit, momentum traders pile in, institutional algorithms start firing buy orders. It becomes self-reinforcing. But more than that, a multi-decade breakout changes the psychology of the market. It tells investors that something fundamental has shifted. It's not just a temporary spike that's going to reverse, it's a new paradigm. And that brings in a different class of buyer. The long-term investor, the strategic allocator, the pension fund that's looking for exposure to this trend. Here's what the chart patterns are suggesting. If this breakout holds, if silver can consolidate above this 40-year resistance level, the next targets are almost unbelievable. Technical analysts are talking about $60, $75, even higher, and those aren't just random numbers pulled out of thin air. They're based on measured moves, on Fibonacci extensions, on the size of the pattern that just completed. But let's ground this in reality for a moment. What would it take for silver to hit those levels? Well, let's do some math. If silver goes to $60, that's roughly double from where it broke out. Is that realistic? Consider this. In 2011, silver more than tripled in less than a year. In 1979 to 1980, it went up tenfold. So a double from here? That's actually conservative compared to historical precedent. And here's the thing about silver that makes it so explosive. It's a small market. The entire above-ground silver market is worth maybe $50 billion. That's less than the market cap of many individual tech companies. It doesn't take much capital flowing into silver to move the price dramatically. If even a small percentage of global investment capital decides to allocate to silver, the price impact would be enormous. Now, let me tell you about what's happening in the derivatives market, because this is where things could get really interesting. There's been a massive short position in silver for years. Commercial banks, hedge funds, various institutions have been betting against silver. And when you have a major breakout like this, those short positions become incredibly painful. They have to cover. They have to buy back their positions. And that creates what's called a short squeeze. We've seen glimpses of this before. Remember the Reddit silver squeeze attempt? That was retail investors trying to force a short squeeze. It didn't quite work because the market wasn't ready. But now, with the fundamentals aligning, with the technical breakout happening, with institutional money starting to flow in, a real short squeeze becomes a genuine possibility. And if that happens, the price moves could be absolutely parabolic. Let's talk about the geopolitical dimension of this, because it's crucial. We're living through a period of de-dollarization. Countries around the world are trying to reduce their dependence on the US dollar. The BRICS nations are talking about creating alternative payment systems. Central banks are diversifying their reserves. And while gold gets most of the attention in this story, silver is part of it too. Silver has always been the people's money. It's more accessible than gold. You can buy an ounce of silver for $30 or $40. An ounce of gold costs over $2,000. For ordinary people looking to protect their wealth, silver is the practical choice. And as more people around the world wake up to the risks in the financial system, as they see their currencies losing purchasing power, they're going to turn to tangible assets. Silver is at the top of that list. Here's something that doesn't get talked about enough: the gold to silver ratio. Historically, this ratio has averaged around 15 to 1, meaning it took 15 ounces of silver to buy 1 ounce of gold. Right now, that ratio is still elevated even after silver's recent gains. If silver were to return to its historical relationship with gold, we're talking about a price that's significantly higher than where we are today. Some analysts argue that the ratio should be even lower given silver's industrial demand. If they're right, the upside potential is staggering. Let me paint you a scenario of what could happen next. Imagine silver consolidates above this 40-year resistance level for a few weeks or months. The breakout gets confirmed. More institutional money starts flowing in. Industrial users start panic buying to secure supply. A short squeeze develops in the futures market. Retail investors see the momentum and pile in. The media starts covering the story, which brings in even more buyers. And suddenly, you're in a feedback loop where rising prices create more demand, which creates higher prices, which creates more demand. This is how parabolic moves happen. This is how you get from $40 to $60 to $80 in a matter of months. It's not a straight line. There will be pullbacks, there will be volatility, but the overall trajectory could be explosive. Now, I want to talk about the risks, because it's important to be realistic. Silver is volatile. It can drop 20% in a week and then gain it all back the next week. It's not for the faint of heart. If you can't handle that volatility, if you're going to panic sell at the first pullback, then maybe silver isn't for you. But if you understand the long-term thesis, if you can ride out the volatility, the potential rewards are enormous. There's also the risk that the breakout fails, that silver falls back below this 40-year resistance level and the whole thesis falls apart. It's possible. Technical breakouts fail sometimes. But here's the thing: the fundamental story doesn't change. The industrial demand is real. The supply constraints are real. The monetary dynamics are real. Even if this particular breakout fails, the long-term trajectory for silver is still up. Let me tell you about what happened with platinum a few years ago. Platinum broke out of a multi-year consolidation pattern. Everyone got excited. And then it failed. The breakout didn't hold. But you know what? Platinum eventually did go higher. It just took longer than people expected. The point is, even if there are setbacks, the fundamental forces eventually win out. Here's what I think is the most important thing to understand. We're at the beginning of a commodity supercycle. After years of underinvestment in mining, after years of low prices, after years of capital flowing into tech stocks and crypto and everything else, commodities are coming back. And silver, with its unique combination of monetary properties and industrial demand, is positioned to be one of the biggest winners. Think about the macro environment we're in. Inflation is still elevated despite what the official numbers say. Real interest rates are negative when you account for true inflation. The dollar is losing purchasing power. Geopolitical tensions are rising. The financial system is more fragile than most people realize. In this environment, hard assets outperform, and silver is one of the hardest assets there is. Let me give you a historical perspective. In the 1970s, when inflation was raging and the dollar was in crisis, silver went from around $2 an ounce to $50. That's a 25 times return. Now, I'm not saying we're going to see that kind of move again, but even a fraction of that would be life-changing for people who position themselves correctly. And here's the beautiful thing about silver. You don't need to be a sophisticated investor to participate. You can buy physical coins or bars, you can buy ETFs, you can buy mining stocks if you want more leverage. The barriers to entry are low. This isn't some exotic derivative that requires a PhD to understand. It's a simple, tangible asset that's been valuable for thousands of years. Now, let's talk about the mining stocks, because this is where things get really interesting for people looking for leverage. When silver prices rise, mining companies don't just benefit proportionally, they benefit exponentially. Their profit margins expand dramatically because their costs are relatively fixed while the price of what they're selling is going up. A 20% increase in silver prices might translate to a 50 or 100% increase in mining company profits. And right now, silver mining stocks are incredibly cheap relative to the metal price. They haven't participated in this breakout nearly as much as they should have. That's creating an opportunity. When investors realize that silver's move is real, when they start looking for ways to get leveraged exposure, they're going to flood into these mining stocks. And that's when you could see triple-digit percentage gains in a matter of months. But here's what you need to understand about this moment. We're not just talking about a trade. We're talking about a fundamental shift in how the world values silver. For 40 years, silver has been treated as an industrial commodity with some monetary characteristics. But what's happening now is a revaluation. The market is starting to recognize that silver is both a critical industrial metal for the future and a monetary asset for an uncertain world. That dual nature makes it incredibly valuable. Think about what's required for the green energy transition. Every solar panel needs silver. Every electric vehicle needs silver. Every wind turbine, every battery storage system, every piece of the infrastructure we're building for a carbon-neutral future, it all requires silver. And we're not talking about small amounts. We're talking about hundreds of millions of ounces per year. The International Energy Agency has projected that silver demand from the energy sector alone could triple by the end of this decade. Now, where's that silver going to come from? Mining production is flat. Recycling can only provide so much. Above-ground inventories are depleted. The only way to balance the market is through higher prices. Much higher prices. Prices that incentivize more exploration, more mining, more recycling. Prices that ration demand. And that's exactly what we're starting to see. Here's the bottom line. Silver just broke a 40-year resistance level. That's not just a technical event. It's a signal that something fundamental has changed. The forces that have been building for years are finally overwhelming the factors that kept silver suppressed. Industrial demand is exploding. Supply is constrained. Monetary conditions favor hard assets. Geopolitical tensions are rising. And the technical breakout is bringing in momentum and institutional money. This is the kind of setup that comes along once in a generation. The kind of opportunity where people who position themselves correctly can see life-changing returns. Not overnight. Silver is volatile and there will be setbacks. But over the next few years, as these trends play out, as the fundamentals continue to tighten, as more investors wake up to this story, silver could go places that seem unimaginable today. The 40-year resistance level that just broke, that was the ceiling. Now it becomes the floor. And if history is any guide, if the fundamentals play out the way they appear to be setting up, we could be looking at a move that makes 2011 look like a warm-up act. The question isn't whether silver is going higher. The question is how much higher and how fast. And for those paying attention, for those willing to act on what the market is telling us, this could be the opportunity of a lifetime.